From the dimly lit parlours of the 1800s to the neon-lit trading floors of today, the spectre of banking conspiracies has loomed large over our financial landscape. In the 19th century, suspicion and paranoia towards banking institutions were rampant, driven by tumultuous events and powerful individuals who seemed to hold the keys to national prosperity or ruin. In the early 1800s, America was a fledgling nation grappling with its economic identity. Central to this struggle was the debate over the establishment of a national bank. The first Bank of the United States, chartered in 1791, aimed to stabilize and improve the nation's credit. But it also sparked fears of centralized power and economic manipulation. Critics, including Thomas Jefferson, argued that such a bank placed too much power in the hands of too few, potentially enslaving the government and the people to a monolithic financial institution. Fast forward to 1837. The United States plunged into a financial crisis known as the Panic of 1837. Banks across the country suspended specie payments, effectively halting the exchange of paper money for gold and silver. This crisis stemmed from a myriad of factors, including speculative lending practices, a sudden contraction of credit, and President Andrew Jackson's controversial decision to dismantle the Second Bank of the United States. Many Americans believed that bankers, with their unchecked power, had orchestrated this disaster, manipulating economic conditions to their advantage, while the common man suffered. Fast forward once more, this time to the 21st century. The 2008 financial crisis, a catastrophic event that reverberated around the globe, reignited those age-old fears giant banking institutions, deemed too big to fail, had engaged in reckless lending and speculative behaviors. Their actions led to a housing market collapse, widespread foreclosures, and a subsequent global recession. Governments around the world scrambled to bail out these financial behemoths, drawing stark parallels to the 19th century anxieties about disproportionate banking power. It seems that history is indeed cyclical. The anxieties of the 1800s echo loudly in our modern era. The suspicion that bankers wield disproportionate influence over national economies is a recurring theme. In both the Panic of 1837 and the 2008 financial crisis, ordinary citizens bore the brunt of financial folly, while the architects of these crises often escaped unscathed. But here's the pivotal question. Are these events simply the result of cyclical economic patterns and human error? Or is there a more sinister, orchestrated manipulation at play? As we navigate the complexities of our financial systems, we must remain vigilant and question the true motives behind the power brokers of our economies. Are we witnessing mere happenstance? Or are we pawns in a larger, well-conceived game? Comment below your thoughts. But until next time, friends, oh really?